right. Well, thank you everybody for joining. This is the third webinar in a short webinar series that I'm putting on for real estate investing and building generational wealth through investing in real estate investment vehicles. I think so far it's been a lot of fun for me to put these together and to teach a little bit. I think hopefully it's been insightful and educational, and you've been able to pick up a few things. Of course, this stuff's relatively high level, and hopefully it'll get you thinking more in gear of investing in real estate assets and what type of future financial returns it can get for you and your family. Tonight, we're going to focus primarily on the multifamily apartment investing vehicle, as well as some commercial investing. As we discussed on prior webinars, multifamily apartment investing is actually my full-time job, and has been for about the last 6 years or so. And so it's a huge passion of mine. It's a significant part of our investment portfolio. And so I love teaching about it. And so we're gonna roll through a lot of that tonight. We're gonna look into some numbers, how the vehicle works, and how you can make money through investing in apartments, as well as commercial industrial space. So here's the schedule. Next week, we're going to do a deep dive into mortgage note investing, kind of a hidden gem of real estate investing not many people know about. But my wife Emily and I have been involved in now for a little while, and it's been really good for us. And then finally, we'll wrap up the short webinar series with a my vision on how to build a plan, based on what you're currently doing today, and how you can get the flywheel started slowly and take advantage of the momentum year after year. Just as a quick reminder, I'm not really here to sell anything necessarily. This is purely educational. Not here to ask for anybody's money. I'm not actually putting on an investment tonight, so we're not going to be reviewing any actual deals that I'm syndicating funds for, anything like that. So this is just for everybody's education and to get a little bit more insights into how real estate investing works. I think most of us have been on the prior webinars, but just as a quick reminder, my wife Emily and I spent the first 10 years or so working in aerospace manufacturing operations. We switched gears and got into real estate when we moved to Texas in 2013. My wife ran our real estate business full time, and it was predominantly single family for the first 5 years or so. And we made a full switch into multifamily apartments in 2017, where I joined her full time after that. So we've both been full time in the real estate space. Me for the past 6 years or so, and Emily for the past 10 years. And we've really built our life around it. We live here in Fort Worth, Texas, and we do more than just investing. We do a lot of teaching and mentoring and things of that nature. So let's dive into the material, and I'm going to start off with a couple of charts that we looked at last week. I believe in this so much that I kind of want to review it. Whether you're looking at multifamily apartments, single family, mortgage notes, land, any sort of vehicle that has real estate behind it, we must realize that the supply-demand economic phenomenon comes purely from the fact that everybody needs a place to live, right? It's part of our hierarchy of needs, right up there with food and things like that. So having shelter, a place to call home, is a need for all of us, regardless of what's going on in the world. So while there are good versus not so great places to invest in real estate, by and large, the entire investment vehicle is just a phenomenal one for these reasons right here. And then we also touched on last week what I'm kind of referring to as the 5 pillars, some of the more important aspects of the investment vehicle, and kind of highlighting and illustrating some insights into how it works and how you can make money doing it. I know when I was first introduced to these concepts back when we started our business, it was so new to me, and some of it was barely believable, right? I didn't quite, understand it fully and didn't quite believe it fully, right? It's like, wow, people actually make money doing this, full time. For some folks, it's more than just an investment. It's their full-time endeavor. So cash flow, equity gains, leverage, tax shelter, inflation hedge, and control. So we'll touch on these again a little bit when we go through a few examples through the charts here, and you'll see this come up again kind of as a theme as we go. So without any further delay, we are going to jump into the world of multifamily apartment investing. And I'm going to attack it from the perspective of a passive investor, really, right? When I first got into apartment investing, I was not out necessarily. I wasn't the one out going and looking for the deals, getting them under contract and leading the investment necessarily. That's my full-time role today. However, when I first started, I invested in other people's deals, right? Built relationships with other real estate investors, people who'd been in the business for a while. And I actually put my investment funds with their companies in their real estate ventures. And so that's what we're going to talk a little bit about here, passive investing in multifamily apartments. And this structure takes on various vocab words, right? Syndication is predominantly the most legally accepted version of the term. Real estate syndication, sometimes you can hear it called crowdfunding. Anyway, the way that we do our apartment investing is through group purchases. And so, believe it or not, driving down the street, you might pass a 200-unit apartment community. And believe it or not, the owner of that apartment community might be just a bunch of people, a bunch of private investors. And actually, statistically, 60 to 70% of the apartment communities in the United States are owned by private investors like all of us. And so here's just a quick and dirty, simple example of a $10 million apartment community. This might be a 100-unit apartment community here in Texas. And the structure of the ownership is really simple. You might have a 70% loan. You might get a loan for 70% of the purchase. And you might raise $3 million of investor funds to close on the deal, right? You bring 7 and 3 to the closing table to make 10, and you've got the deal. And this is this is very common, right? These figures are very common. The $3 million of equity and the down payment comes from folks like you and me who are looking to put their money to work for a return on investment. And so this at the highest level, this is really how they're structured. Down at the ownership level. So when we look at the folks that are actually involved in the deal, you and me, the investors, we've got passive investors, sometimes called silent investors or silent partners. And then we've got deal sponsors, lead investors. Sometimes apartment deals will be done inside of a fund. And so you'll have like the fund manager or the fund sponsor. Either way, you generally have a group of people who are just investing their money. And then you've got a group of people, or maybe it's a single person, who is responsible for the asset's performance at the end of the day, right? That person manages the asset's performance. They implement and execute the business plan. They deal with all the investors. They are, a distribution, dividend relations manager, right? And to some extent, as some of these sponsors and these funds have deeper and deeper relationships with their investors, you kind of become a portfolio manager potentially for your investor. And so really, it all comes down to workload and risk. I mean, everybody's sharing in the risk of the investment. The deal sponsor tends to take on a significant amount of risk at the early going, right? When the deal's put under contract and you're doing inspections and things of that nature. And then, of course, the passive investors, the main benefit there is there's no work involved, right? They're completely silent. They are putting, the trust but verify model into the deal sponsor, and investing with someone that they know, like, and trust, with a track record, and sitting back and just collecting a return on their investment. One final point here that's important, in most of these structures, the passive investors will have a certain ownership percentage, and then the deal sponsor or the lead investors will also have a separate ownership percentage. And I put some ranges in there, 70 to 90% ownership for the passive investors and 10 to 30 for the deal sponsor. Simply what that means, if we go back to the prior chart that had the $3 million of equity, and that's really what this relationship is built of. It's the equity piece. For their investment, the total number of passive investors, and let's say there's 100 people, will make up, let's call it 80% of the ownership. They'll own 80% of the equity in the apartment community. And then the deal sponsor, for whatever they've invested, plus their time, risk, everything else, they'll get, let's call it 20% ownership into the equity structure. And so that sometimes is called a general partner split or GP-LP split. It simply is a split of the equity ownership, and everything is determined on that from an equity perspective. Not to get too deep in the weeds, but any profits, any distributions, when you sell the property and you make a significant amount of money, the deal sponsor will get his percentage split, and then the passive investors will get their percentage split based on how much they put in the deal. So that's how the deals are structured at the ownership level. And again, just kind of one more point between the two groups, and Emily and I do both of these, right? We're invested, north of 20 deals as passive investors. So I've invested in other people's deals, and then I also have my own deals. So we do both, right? It's part of a diversification and taking advantage and leveraging other people's time. I don't have the time or, the team or the structure to go out and buy 20 to 30, 200 unit apartment buildings, right? I may want to do that someday, but that's not today. And so I leverage other deal sponsors' time to go do that. And so it truly is a win-win. At the end of the day, right? There's deals going on, people that I know, like, and trust, invest in their deals. And likewise, I've got investors invest in my deals, and they take advantage and leverage my time and my expertise and things like that. So it's really a cool little structure. I'm going to talk a little bit about our criteria and educate us all on, what we look for in apartment deals. And this is a typical class structure for apartments. And if you've been researching this, you might have seen this, you might know this already, but we've got Class A, luxury, new build, generally anything that is in a urban or suburban area that's been built in the past couple of years is going to definitely be Class A. This is your luxury apartment complex. If you're in Texas, it might cost $3,000 a month for a 2-bedroom. If you're in California, it might be $5,000 a month, right? These are very nice places to live. White collar, young professionals, people that are highly successful. Class B, you're a little bit more working class. These are properties that are built in the 80s, 90s, and 2000s. And again, urban, suburban areas, very nice places to live, very family friendly. This, I would say, is pretty much our bread and butter, Class B. Straight down the fairway, very good amounts of value add, going in and improving the properties and profiting off of the market. Class C, even more working class. These are properties built typically in the 60s and 70s. These are your wage workers, construction workers, the person pouring coffee at Starbucks, right? And so what's really neat, when we look at Class A, B, and C, there's a very, very clear fundamental economic phenomenon that takes place in good markets. So let's take Texas, right? Texas is a very good market. A lot of people moving here, a lot of businesses moving here. And what's really neat to watch is as they build more apartment complexes, say Class A, and as businesses move here and people start to move into these places, for every one tenant, for every one white collar business professional that's going to rent a Class A unit, requires 2 to 3 Class C individuals from a demographic standpoint to support that person. Okay. So for example, the individual living in the Class A unit, right, works at Texas Instruments or American Airlines, or has, a white collar, 6-figure job, and they need to buy Starbucks, and they need to have their car washed, and they need to have XYZ, right? Well, that person requires the support system, the support network of multiple people living in the Class B and C apartment communities. And so that is what typically, when we have high growth in markets, construction, people moving to strong markets, that's what really, really bolsters the demand for Class B and C apartment space. It's really a cool phenomenon to watch. Class D stands for do not invest. And it's true. This is slumlord. This is dilapidated, maybe really poor areas of town, not kept up. And so, hey, people make money here. I know I have friends that invest in this stuff. My advice would be to steer clear, right? Especially when the economy's kind of, not as strong as it has been maybe in the past several years. So yeah, Class D, do not invest. So A, B, and C, and to kind of dive a little bit deeper into more criteria and what makes a good apartment community to really target. And I say, I'm going to roll through these bullet points, but, keep in mind, there's investments in all types of real estate, and there's people that find opportunities and make good money in various forms. So this isn't none of these are deal killers. If it's not the case, this isn't an end all be all, but, low rise garden style, 2-story, 2 to 3 story. Here in Texas, if you've got more than 3 stories, you need an elevator. That brings other challenges, right? And so you pick your niche. Either you like to do the high rise stuff or you don't. For us, it's the 2 to 3 story stuff. Subsidized housing, government housing, housing vouchers, low income benefits, things like that. Again, that's more of a Class D environment, demographic. And so we generally do not participate in that. Stabilized properties, greater than 90% occupancy. I think there's a little bit of a misconception out there that to make money in apartments, you have to, buy distressed assets and kick everybody out and get the occupancy down to 10% and fill it back up. But it's just not the case. You can do a lot of damage financially and have great returns with stabilized properties that are already, humming from a performance perspective. The size of the property is important. Property management is not cheap, right? And so if you're going to be employing the help of a property management company, which, obviously a lot of folks do, you generally have to be 100 units and higher. Below that, it just economically, it's tough to make it work. So 100 units and up is generally the target. We've talked about the market before, but it's worth repeating. You want to invest, if it's apartment complexes that you're interested in, you want to invest in high growth markets where there's definite population growth, business growth, and people coming to the market, right? It just really, really mitigates other risk in the marketplace. And it really makes for a great foundation. Landlord-friendly jurisdictions. So this is kind of a hidden one that not a lot of folks think about, but when it comes to operating an apartment business, and especially if you've got a portfolio, let's say you do decide to get into apartments and you invest in a couple deals. Now you, as a passive investor, you might have 800, 900 units in your portfolio. Well, not all 800 or 900 tenants are going to pay rent all the time perfectly, right? It's a living, breathing business. Things happen. So for that reason, we want to operate in places where the laws are landlord friendly. Okay. COVID was a fantastic example of this. In Texas, we have very, very landlord friendly legislation. And generally speaking, if someone doesn't pay rent, and if I, for some reason, don't feel like we want to work with that person, which generally we sometimes do try to work with people, but I literally can have somebody out in 20 days in Texas. It's relatively easy. During COVID, it became a little challenging. And we definitely had a lot of rent relief and some stipulations there, but it wasn't that bad. I mean, we had about a 2 to 3 month moratorium on evictions, and then Texas was pretty much back to work, and we could go back to what we needed to do there. So making sure that the legislation and the laws favor the business owner and the landlord is very important in this business. And then strategy, picking your strategy. And we'll talk about this when we dive into the numbers, but we've got deals that need some work. Okay. And deals that you have to bring a lot of capital to and spend millions of dollars to improve the community. And then there's properties where, hey, it's already running great. Yep. I'm going to have a little bit of a capital budget, but not much. And we're just going to keep going. And, that's, stabilized deal versus value add, if you want to call it that. It takes on various forms. But I'll show you some pictures here on a future slide where we did some improvements to a property, and we call that value add, right? We're adding value to the property through capital improvements, and therefore we can extract that value as profit at the end of the day. All right, so let's dive in. I know everybody here, we've all already worked today. We're all trying to turn the brain off a little bit, but let's go through a little bit of math. I'm going to start. I know we're talking multifamily, but I am going to just make a quick comparison here. When it comes to valuing real estate, okay, and commercial real estate in general, we use an income-based method, right? When you buy commercial real estate, when you buy apartment complexes, you're buying a business, okay? When you buy a single-family house, you're essentially buying a home perhaps in a neighborhood that's surrounded by similar homes, right? That's very common. And so how your home, if say you live in a home in a neighborhood, that home's going to be valued based on its comparative properties, right? It's going to be, based on what your neighbor's property is worth, right? If your neighbor across the street sold their house, let's say they refinished the kitchen, changed the flooring, and sold their house for $500,000. Well, there's a very good chance if your house looks pretty similar and is about the same size, $500,000 is a good bogey. Okay. That's not the case in commercial real estate. It's not the case in multifamily apartments. In multifamily apartment communities, the value of the asset is based on the net operating income. Okay. So if I take all of my income and pay all my bills, pay all my expenses, I am left with a net operating income. And that figure is used to gauge the health of the business. Makes sense, right? Hey, if I make a lot of money and my expenses are in control, I have a high NOI, my business is healthy, okay, compared to everybody else, all right? And that's how apartments are valued. So the name of the game is to increase your net operating income. That's the name of the game. That is how we, quote unquote, flip apartment complexes, right? If you watch a lot of HGTV and you see the home flipping shows, people buy the single family house for $200K, they put 100 into it, they magically sell it for $500,000 and they've made some money. In multifamily, it's similar, but different, right? The math is different, right? We buy the property, we bring capital investment, right? We improve the property, we increase rents, we optimize our expenses, we make it a better place to live, better value for us, better value for the residents. And what do you know? The property value goes up. Okay. Let's walk through a couple of just definitions here. Net operating income, just to kind of, elaborate further. Income less expenses. And it truly is this simple, right? Your income is your rent, obviously, right? Rent is the biggest part of the income chain. And then you've got some non-rent items, late fees, reserved parking. At one of our properties, we charge the residents if they want to rent the clubhouse, say for like a kid's birthday party or something, right? They pay $300 for the weekend or for the day. And that's a non-rent income, right? Expenses, management fees, payroll, utilities, property taxes, anything that you might associate with the operation of a apartment community is an expense. Okay. And after we're done paying all those bills, we've got our income less our expenses. We've got our net operating income. And that's, and that's the figure that's used to determine value. These items are not included in the net operating income figure. These specific, I'll call them expenses. These specific items are taken after your net operating income. And the reason for that is they are not necessarily an indication of the financial performance for that specific asset. So your mortgage payment, that's not in the NOI calculation. Why? Because, I may buy my apartment complex with debt. I might have a loan, while Joe Smith, apartment buyer, he might buy the apartment complex without a loan. He might just pay cash. So we can't use the mortgage payment as an indicator of property performance. Large capital expenses. Okay. If I'm going to install a swimming pool and spend $100,000, that's a one-time thing. Yes, it does improve the property, but I don't want to say that, now my net operating income is lower because I put a swimming pool in. Actually, it's probably going to make the property's value go up because more people are going to want to live at the property. So that doesn't count. And then other non-operational transactions, contract signings, bonuses, things that just are not indicative of how the property operates on a day-to-day basis. And then cap rate. So let me go back here to our equation because I glossed over it. So property value is directly related to the NOI. We talked about that. NOI goes up, property value goes up. But the scalar, the denominator of this equation that kind of scales across the board commercial real estate is what's called a capitalization rate or a cap rate. Okay. And cap rate is probably the most misunderstood and hard to describe definitions on earth. So here's the way I like to think of it. Let's assume that we have an apartment community, and let's just say, hey, easy math, it generates $1,000 per month of net operating income, $12,000 a year. Okay, perfect. How many of us would pay $1,000 for this property? In a heartbeat, right? Buy a piece of real estate. I make my money back in the first month. Easy, right? So, okay, $1,000, that is definitely not the value of this property. That would be a 1,200% annual return. Okay, well, if it's not 1,000, well, how many people would pay 10,000? Okay, well, I still would, right? 120% annual return. That's fantastic, right? Basically make my money back in less than a year. So that's great. Okay, well, if it's not 10,000, maybe it's 100,000. How many of us would buy the property for 100,000? Okay, yeah, I think I would. 12% annual return. That sounds pretty good to me. I could deal with that. Or maybe it's 10 million. I don't know. 10 million is probably too expensive for $1,000 a month because your annual return wouldn't even be a percentage point. And I can get better than that in my savings account. And so you see where this is going, right? There's a cap rate that defines what the market is willing to bear on a return. So we just went through it. We just kind of stepped through different pricing and we said, yeah, no, it's going to be higher than that. It's going to be higher than that. Oh, okay, 12, that sounds pretty good. Oh, 10 million? No, way too high. And so in this example, if we reverse the equation, okay, and say, all right, well, I'm going to solve for cap rate now. I'm going to take NOI divided by property value to get a cap rate. And in this case, it's simple, just because of my simplistic math, the cap rate's 12%, right? Now, someone might be willing to say, and this is where we jump into reality, someone might say, well, guess what? I'm willing to accept less than 12%. I'm willing to accept 8%. And so that drives the price higher, right? And so that's what the cap rate is. It's an indication of where the market values a certain net operating income level. So I hope that, cap rate's pretty difficult to explain, but I hope that did help. And we can, at the end here, if there's some Q&A on that, I'd love to go through that again. Okay. NOI goes up, property value goes up. That is the name of the game. Okay. So I buy my property. And let's say that when I bought the property, the net operating income was 600 grand every year. And through property improvements, rent increases, improving the units, making it a better place to live, installing value, let's say I increase it to 900,000 a year. And, let's say it took me 3 years to do that, right? It's a big project. Well, using the equation we just learned and a typical cap rate today of 5%, you can see that I've added $6 million of value to my apartment community. It's not magic. It's simply taking advantage of the fact that, hey, there are improvements I can make, and I'm going to extract value from the property through those improvements. Sometimes, and we absolutely do not bank on this, sometimes the cap rates change, right? Sometimes the cap rates go down. And so you could just sit there and not increase your NOI. And if the cap rate goes down, you make money, right? That's called gambling. That's not smart to do that, right? Always go into your investments knowing that you can add value, right? Because we can't just be raising rents without adding value. Let's talk through, let's use some real numbers now. And I think this will really come full circle for everybody. So this is an apartment community. Actually, I was just at this community today. It's a beautiful community in Fort Worth, Texas, 1986 construction and 240 units. And we bought this property for $31.5 million back in 2020. So right at the end of the year, 2020. And today, through all the concepts we're talking about, if you were to take the financials and do a cap rate equation, you would come up with a value for the property today at right around 40 million. All right. And we're going to walk through that math. In the deal, if we're talking about structure, we've got 147 investors. So 147 folks came together, threw money into the pot for the down payment, and that money was $12 million. So right off the bat, you can see investors brought 12 million and the bank, the lender, brought the rest. And we'll go over a little bit of that too. So let's go through our quick pillars here and let's talk the numbers. So cash flow returns on the deal. So the property cash flows $500 a month for every $1,000 invested. So 6% cash flow annually. And so if you invested 50,000, it'd be 250 a month. Straight math, right? So there's the cash flow. And we talked a little bit about how this all works last week, but I want to make sure we use real examples to talk through the numbers. Equity gains. So this is kind of what we're honing in on this week through this webinar. Through our net operating income increase, the property is worth $10 million more today than it was 3 years ago. Okay. And that was not just magic. In fact, the cap rate has stayed the same the entire time. That is us improving the property, making sure it's a great place to live. In fact, the reason I was at the property today was because we are spending $30,000 putting in a fire pit with Adirondack chairs and a cabana. And so we continue to throw money into the property and make sure that it's a great investment for the people who live there and the people who invest. On the financing side, we secured a 12-year fixed rate Freddie Mac loan. So same type of loan that you might get on a single family house. I mean, it's very similar, except this one happens to balloon at 12 years, right? It's not a 30-year. It's a 30-year amortized loan. It just doesn't, you don't have 30 years to pay it off. It's a 12-year balloon, and interest rate 2.8%. So this is the one property that we got in at the very, very bottom. And the lender brought, as you can see from the math, a majority of the acquisition. So they brought 20 million, and our group brought the balance. Taxes and inflation. So if you guys remember from last week's webinar, I talked a little bit about bonus depreciation, accelerated bonus depreciation, the ability to write off a significant portion of the asset in the first year of ownership. And so On this specific property, for every $100,000 invested, the investor would receive a $70,000 paper loss in the first year that they could go use elsewhere, right? Say maybe they made a profit on another investment. They could use that write-off to eliminate their tax burden for that year. And control. And again, last week we talked about how this one's it's a little nebulous, right? There's not a lot of numbers around this, but I can guarantee you it's probably the most important one on the page. For me as the deal sponsor, I live 10 miles from the place. So I can get there. If I wanted to go right now, I could. And I can check the status with the staff. I can talk to the staff. I can, see what they need, support them every bit of the way, right? It's kind of humbling to know that, hey, you've got 4 or 5 people that work at the property managing your $32 or $40 million asset, right? So it's a great investment vehicle for control. From a passive investor perspective, there's a lot of accountability on my shoulders because I'm the deal sponsor, right? But if this was a deal that I invested in passively, I would love the control aspect because it's a market that I like, with landlord-friendly business laws and everything like that, and a group that I've gotten to know and have a relationship with, and they have a track record, right? So I'm gonna invest with that group because they know what they're doing, and that's oh, and if I have a question, I've got the person's cell phone number and I can give them a call. So talking a little bit more, we'll peel the onion back just a bit further on the NOI piece. And this is simplistic and it may be obvious, but it's really the most significant part of Eagles Point's business plan execution. And it is hands down the main reason why the property is worth what it's worth today. You can see the picture at the top there. That is a as received apartment unit. When we bought the place, that's what the apartment units looked like, more or less. Very livable, pretty working class. I mean, hey, looks great, right? But when you go around and do the market study and understand, hey, what do the tenants really want? What are they willing to pay for? The bottom picture is it. And so what do? We take $10,000 per unit and we do a total makeover. Okay. And you can see the improvements are drastic. They're just amazing. So are the financial performance indicators. A classic apartment unit rents for $900 a month. My upgraded units rent north of $1,200. And so for $300+ premium, we're able to make the units look better, more amenities, better place to live, fix all the maintenance issues, and the residents are the market will support it, right? We essentially wouldn't do it if the market didn't support it. So that's that. And okay. So we talked a little bit about the NOI at Eagles Point. We dove through some of the financial parameters, right, from the pillars that we talked about last week. Let's talk about bottom line, what this looks like for the investor, so that we can say, all right, I get it. The NOI goes up, the property value goes up. I totally get it. Understand. Everybody needs a place to live. Got that. Okay. Well, what does it mean? How does the math trickle all the way down to me, the person who put money in the deal? And here it is. So just a quick summary. The math that explains the NOI improvement, right, and the property value. And here is the investment. And so my investment, $50,000, happens to be a tiny portion of the 12 million, right? Small amount. And here's the math that shows what the investment does through that value add net operating income increase. So, okay, we'll take today's value, and we haven't sold the property yet, so this isn't a real return necessarily. Today's value minus purchase price, and that's the additional, let's call it equity. If we were to sell the place, it'd be the additional profit, right? And so instead of $12 million of equity, which we had at the beginning, We add to that an additional 10,500,000. And now we've got north of $22 million of equity in the deal. All right. Well, I own 0.4% of the deal. And so 0.4% of that new equity figure is $101,000. So that's how on Eagles Point specifically, we are going to make a return on investment for the folks that are involved in the deal. Is NOI increase. You can see what that does to the equity piece, right? If you sell the deal, maybe we refinance. I don't think we will. That we've got a great loan already. No need to refinance into something different. But if we sold the deal, we've got our new equity position, and you essentially split the profit based on how much money you put in the deal. That's really how it works, right? That's how it works. So 50K turns into 100K, and that's how the apartment investing numbers work. I went through a ton of numbers there. Any questions on any of that? Any of the mechanics there? Cool. Bring it up. If you have a question, definitely come up. Okay. So that is the apartment investing world. I'm going to jump into commercial investing, and I think commercial industrial investing. I think the first thing you're going to realize is, wow, this works the same way. And it does, essentially. I mean, it's a different type of, it's a slightly different type of investment vehicle, has different attributes, works a little differently. But at the end of the day, the valuation, the mechanics of the financials and all that are exactly the same. I mean, they're not different at all. And you'll see the similar looking charts too. So triple net industrial commercial investments. You might be surprised, as I was, that a lot of businesses do not own their own industrial space. Okay. Actually, this might be probably a pretty terrible example, because I think Amazon actually does own a lot of its own real estate. I might be wrong about that, but I think that might actually be the case. But by and large, and there's the same classifications. There's Class A, Class B, Class C, Class D industrial space. And by and large, a lot of Class B and C industrial space that I've gotten involved in, I mean, it's all private investors, right? And none of the businesses that occupy the space actually own their own real estate. So again, like apartments, it's you and me that are the driving force behind these investments. And we're taking advantage of the triple net scenario, the triple net lease scenario. So what is that? Triple net, NNN, triple net. This is about the best way to explain it. But the cool thing is, in triple net, very few expenses related to the real estate are paid by the owner. And you can see the comparisons between single, double, and triple net. In the green box, you can see that the tenant covers the rent, obviously. They cover the property taxes. They cover the property insurance, and they even cover specific maintenance items. So this is super powerful because it means less financial risk for me, the owner. Okay. I've actually got a tenant who's willing to not only pay the rent, but most of the very expensive expense items on the P&L, right? When we went and looked at net operating income earlier, property taxes are huge, right? On a $30 million commercial building, your property taxes is probably like $800,000. So this is really, really powerful stuff. And to kind of peel back the onion a bit on why, and I'll be honest with you, right? I started doing, 7 years ago, apartment investing. That's been my full-time thing. Commercial investing, something Emily and I got into about 3 years ago and have just had a lot of fun with. And so for me, this chart, as I talk through some of the rewards and the things to consider, is purely coming straight from my perspective, right? The returns on the commercial investments are predictable. Why? because we are usually locking our tenants into long-term leases that have built-in rent increases. And like I said before, we're not having to deal with any of the other expenses. So there's no surprise insurance expenses. There's no surprise maintenance expenses. It's pretty much simply the rent. Okay. Our tenants are usually longer term. Okay. The deals that we are in are generally 5+ year leases. And so it takes away, in an investment where you're probably only going to own it for 3 to 5 years. I mean, it takes the risk of someone moving out completely away. And so that's great. And then we talked about the lower financial risk. Some things to consider. And, this isn't supposed to be like a pros and cons necessarily, but there's definitely some things to consider when it comes to these triple net scenarios. Because, you might be dealing with, let's say, that Amazon facility on the last slide, and Amazon occupies all 200,000 square feet of the space. Well, if you're too aggressive, or if you are not a good negotiator or not a good, owner, well, then they might move out. And then you've got a large empty building. That's one of the reasons that we try to reduce that concentration risk with multi-tenant industrial space, right? Okay, it might be a 200,000 square foot space, but I've got 5 tenants maybe. So if one moves out, I'm not as exposed. Risk reward though, right? Risk and reward. And for that reason, we look for, good businesses to occupy the space that are willing to sign up for long-term leases with built-in increases at market. And we try to stick to that model as much as we can. And if you're smart with that, if you're smart with that model, then you'll have a lot of happy long-time tenants. And, they would only shop for a new space or move their business if for some reason you weren't keeping your rents at market, or if something else was wrong with the building. So this happens to be just a really, really good way to diversify. And that's what it was for my wife, Emily, and I. We kind of realized, hey, we're pretty loaded. We're pretty, heavily invested in apartments, and it's great. It's doing great things for us, but it's maybe a little bit too, too single-minded and single-focused. And so commercial, 3 years ago when we jumped in, was a diversification. And that's really what it has been. And it's been great, right? It operates differently. It's got kind of a different market, different feel. So you can take advantage of that. Let's go through a quick example here. So this is actually a deal that we did just about a year ago. So about 12 months ago. And it's right on a major highway in North Dallas. And it's 7 buildings, 40 tenants. So there's that multi-tenant setup, right? It's not 7 buildings and 7 tenants. It's quite a few tenants. It's all mixed use. There's even some very small retail frontage, and it's mostly flex space, so storage and retail and things like that. Here's where everybody's light bulb should go off here pretty soon after what we talked about with net operating income. So when we bought the when we bought the industrial complex back in 2022, the leases were expiring, and some had already expired. Okay. And most of the leases, average across the complex, was just about $5 a square foot. Okay. So that's how we, in industrial speak, that's how we measure the lease rates, by square footage. And when you go around, do the market study, find out what everybody else is paying, it's $10, north of $10 a square foot. So right away, we saw massive opportunity. We said, okay, wow, these folks had been getting a sweet deal for way too long. The seller was, they'd owned it for years. They're ready to cash out. And so we came in and picked it up, right? And being in a great location, a lot of traffic, it's kind of a legacy, it's definitely a Class B, maybe Class C space, built back in the late 70s, early 80s. So just fantastic opportunity to really add some value. And it's right here. It's staring us right in the face. It's the value add. And so you say to yourself, okay, everybody's paying $5 a square foot for rent every month. The market's 10. Okay. Well, I'm going to go in and I'm going to negotiate new lease terms with everybody who has an expired lease. We're going to go in and do 7-year leases, and we're going to move it up to $10 a square foot. Okay. And sure, you get little mixed reactions, right? It's like, okay, great. Yep. Let's do it. I know I can't get anything better anywhere else. A lot of businesses are like, hey, I don't want to move. Like, my customers know that I'm here. I don't want to have to go through that. Some folks are like, some of the businesses were like, no, I'm going to go shop around. Let's go see what else is out there. Yeah. Some people, maybe you find something. Likely not, right? More than likely you don't. And at the risk of, having to relocate your business, a lot of people just stay. And so, this is kind of how the numbers look on this deal. And of course, this is more of a pro forma because we just bought the deal last year. But NOI at purchase was roughly $340,000. And so you can see on that cap rate, we basically paid about $7 million for the industrial complex. So far, so good. Year one's been great, right? We're right on line, almost $500,000 of net operating income. And then after year 3, so in a couple years from now, we're projected to hit about $645,000 of net operating income. And how do I know that? Well, we did the market study. We understood where the market was for lease rates. We're going through and executing that right now. And so far, so good on the projections. And so if we continue that business plan execution, we're going to be right in line. And, assuming the cap rate stays relatively steady, we're going to be, 12 million or so, 13 million on property value. And that's just it. So, very similar to the apartment community and how the math works on that. You go in, you take advantage of the market, right? You bring the lease rates up. I would say the significant difference here is just with the triple net situation, the only real capital improvements that our ownership group is going to be making or has to make is really to some of the common areas, parking lots. A couple of the buildings had some foundation items that needed to be rectified. But besides that, it's not like the apartment complex where we're, spending money to improve the living space and the interiors. That's more or less on the business owner, the tenant, in this scenario. All right. And so how does that affect and impact my investment? So see the math here. Makes sense, right? Investment. Let's say somebody invested $200,000 into this deal. And actually, this specific investment was kind of flip-flop. The equity investors brought a little bit more to the table percentage-wise than the lender. So we've got $4 million of investor equity, and 5% of that is the 200 grand investment. So you invest 200,000, that's 5% of the ownership slice. We saw the math, right? If you've got a hypothetical, this is all hypothetical because we still own the property, but if you have a sales price near 13 million, you've got the purchase price near 7 million, then you've got about a $6 million increase in value, right? And like we talked about last week, the bank, they don't keep that, right? It's the investor, it's the owner that keeps that equity increase. And so our new equity position in the deal is roughly 10 million bucks. And 5%. So the 5% ownership slice of the equity position is 500 grand, $500,000. And so, so if someone were to invest 200,000 into this specific asset, and if you were to assume that this asset over the next couple of years had these, this performance, it'd be a nice healthy payout, right? And you don't have to invest 200,000. Okay. There's folks in the deal that invested 35 grand, 50 grand. So yeah, it's just a group purchase where everybody throws their money in the pot, and we go improve the value and rinse and repeat. So kind of to wrap up a little bit, I wanted to cover this. I took these charts. I took these charts out of a investor presentation. Every year, my wife and I present in front of folks, and these are common questions that come up, and I think they're good to go over because it's like, hey, how does this work further? What does it take from a, type of cash or type of investment standpoint? And so these are super helpful. It's a lot of the common things that come up when you talk about group purchases, which both examples we talked about tonight, both the industrial as well as the apartment community, those are both group purchases, right? Emily and I did not go out and spend $31 million to buy an apartment community, right? That's with the help of many, many other people. So, what money can you use? There's officially about 18 different ways you can invest in these deals, right? Cash, simple. Entities, businesses, trusts, actually the one that's probably the most popular is retirement funds, right? A lot of people invest their retirement funds into these deals. And for folks who have worked at corporations before and, rolled over, a 401k or something like that, that's actually really common in the world of syndications, right? Is rolling your retirement fund over to be able to do these deals. And it's penalty free. It's completely legal, the whole deal. Typical returns. I mean, we showed some numbers tonight, but this is usually what we underwrite to 80% total return. So I'd say pretty conservative. Investments, it really depends, right? I've never turned away an investor, but a lot of the deals come out are 50, 75, 100K. The apartment investments and the industrial investments are not liquid in the sense that, you can't invest and then 2 years later in the middle of the business plan, request your funds, right? These are hard investments. And you basically want to make sure you don't need the money to go buy groceries or things like that. We talked a little bit about cash flow distributions, and those are paid typically monthly. A couple of the industrial ones pay quarterly, but it just kind of depends on performance. You can be accredited, non-accredited, all of the above. There's no accreditation requirement for these group purchases. From a tax perspective, we talked about K1s. I showed you an example of a K1 last week. And so that's how these group purchases are done. At the property level, a tax return is completed for the LLC that owns the property. And then from that tax return, every investor gets a partnership form K1 that shows what their specific performance was out of the investment. And then, we generally keep an investor database. We've helped a lot of people get into these deals, but like I said earlier, this isn't necessarily, it's more educational. This isn't there's no investment to be made tonight. So if it's something you want to get into and do some more research on, we, definitely get with me later and we can talk about that. But that's it's going to wrap up my presentation on apartment investing and industrial commercial space. Both excellent ways to build your real estate portfolio and build generational wealth. Apartments is my full-time job, so I'm super passionate about it, as you can probably tell. And commercial industrial is slowly turning into another passion of mine. It's just really, really good. Next week, we are going to tackle a hidden gem type of investing, mortgage note investing. This is you, the private investor, becoming the bank, buying the mortgage note from the Wells Fargo, from the Bank of America, and then becoming the lender. So this is super powerful. I'm really, really excited to dive into this one because I think you're just gonna, I mean, heck, a couple of years ago, I didn't know much about this and I was blown away. Right. So I think this is really, really going to turn some heads, and I think you're going to love it. So please mark your calendars, and obviously if you can't make it, let me know and I can shoot you the recording. It's going to be a good one. With that, why don't I open up for questions if there are any? We went through a ton of numbers and a bunch of scenarios, and I'm sure I didn't speak it perfectly. So anything come up that you guys want to ask?
Hey, Adam, it's Chris. How are you?
Man, it's good, Chris. Good to reconnect with you.
Yeah, it is good. By the way, the Texas accent suits you well. I don't remember hearing that when I sat next to you.
I know.
Hey, I just got a quick question. I actually walked away from a multifamily deal today, and I wish you had offered this to all of us a year ago. Would have been awesome. But I liked your NOI and your NOI chart, and I know you wanted to go back to it. But my question is on that particular deal, you had 2.8% on a 12-year term. The reality is rates today. The reason I walked away from a deal today, the lowest rate I could find is 8.1. What exactly are your thoughts with the interest rate? I mean, no one has seen into the future glasses. But how do you make these deals work with the current rates at 8%?
It's tough. It's really tough. And I'll be honest with you, Chris, it's one of the reasons I'm excited to give this presentation and educate but at the same time, the market's not great today. So the fact that you walked away from a deal is probably real smart, right? I mean, Emily and I have not invested in a multifamily apartment community for 11 months. So it's been a year. And that's after doing 3 to 4 acquisitions a year, the past 6 years. So your point is 100% spot on. What we are seeing in the market today, and what the point that Chris is bringing up is the capital markets, the financing is not friendly today, right? The banks they're not confident in the market. They don't feel like they can get a return themselves. And so what's happening is like sellers, people who want to sell a property, they think their property's worth 50 million bucks. And me as a buyer, or you, Chris, as a buyer, you look at your financing options, you look at your equity options. I mean, people, they don't do these, banks and investors don't do these deals just for fun, right? And you look at your options, say, hey man, I can't pay 50. I can pay 45, but I can't pay 50. And then all of a sudden the seller says, well, I'm not a seller then. And the result is the market has stagnated big time. And it's going to take loans coming due primarily to stoke the market. And what I mean by that is all of a sudden the deal that you might have been looking at, let's say 6 months from now, a year from now, the seller says, oh shit, like I should have sold when I could because, my loan's coming due. And as you pointed out, these loans aren't 30-year loans. And so when that happens, the seller's feet's to the fire. If the bank doesn't want to extend the loan or refinance into a loan for them, they're going to have to take their equity and sell the deal. So that's coming. I don't know if it's going to be blood in the streets necessarily, but the market is stagnated because buyers and sellers just can't get on the same page.
All right. So what you're trying to say is Texas isn't any easier than California.
No. 100%. Yeah. To give you some data there. There's a very high profile broker here in Dallas that he was telling us last week that in 2022, his firm did 95 apartment closings. And in 2023, he's done 4. So
wow,
if that's any indication. And that, hey man, that is a market where people are still moving to, and there's still pent up demand. So it'll be interesting to see how it opens up. But yeah, I still wanted to do this presentation and get everybody educated because to your point earlier, it might be coming. There might be a tidal wave of good deals coming down the road.
yeah, because actually after today's deal, because I have an investment partner, we actually pivoted into the year do not invest in the Class D. And we looked at about 3 different properties today.
Oh, no. Well, I hope you Class D did not invest.
Well, and we don't know yet, but the reality is we looked at, we're looking at multi units close to universities, close to, and looking at doing some student housing or something else. But I mean, to your point, I think your example is spot on. When you bought the property, it was 1980s style, and now it's 2020 style. And what we looked at in a couple of the foreclosures today, I mean, they're even 1960s style. So you go in, invest a couple $100,000, you turn around, and it's the current market value, if it was fixed up, is about 1.8, and right now we can pick it up for 700. So there's some flexibility there.
Man, that's not a bad little deal, right?
No, but it's just it's in a low income area, right? So your property, your rent's going to be probably high probable Section 8, which isn't necessarily bad, guaranteed income, but it's not in the middle of prime Orange County or Texas.
All things that you have to consider. Yeah. I mean, I think that's worth looking at, right? Because with that much value add, it's definitely an opportunity.
Yeah. So okay, just but again, I mean, I wish I've watched your journey over the last couple of years. I think these weekly things are fantastic, and I truly appreciate it because you're somebody I actually know and trust versus some ding dong on YouTube or Facebook say, hey, come buy my course.
Hey, I appreciate that, man. Thank you, Chris. Any other questions? As always, you can reach out to me. I actually had a call with someone today who reached out. So yeah, definitely feel free if this spawns any discussion points or questions. I love talking about it. Happy to help. And as Chris pointed out, the market's not real active today. So I think it's a good time to network and reconnect with each other and do some education anyway. So if anything does come up, please feel free to set up some time or shoot me an email. Would love to reconnect. But all right. Well, everybody back to their families. Enjoy your evening and look forward to tuning in next week. We can talk about mortgage note investing. So have a good night, everybody.